Hello guys, how are you? Hopefully doing good. Today we will be covering the SmartCenter REIT. The ticker name is SRU-UN.TO. This is our own local Canadian REIT, and I'm very happy to cover this. Most of the time we cover US, and I always feel like if I'll cover more of the Canadian stocks and invest in locally. So thanks to Mr. Tom Alexander. So Tom requested this smart read that if I can do this video on my channel. So I get a chance today to do this video, although this was not in top of my list, but I just tweaked the list because of the Canadian stamps on it. Okay, so that's about it. Sorry about that, but I think I haven't did a read for a while, and some other investors also requested as well. So let's get started. Okay, so what's the agenda? Okay, let's say, so this is the agenda. We'll do the business overview, and then we also showcase this time, because I think we need to showcase if the companies not only increasing the bottom line, but I also like the companies who helps as terms of the humanity, right? Because that's very important, especially in the case of COVID-19. So I'll put a slide on that as well, and then we'll see from the investor perspective their financials, the revenue diversifications, risk, and then form the opinion, right? So let's get started without further delay. Okay, so for me, who I am, okay, I am Pramod Kumar. I am a CFA charter holder and FRM certified. This is my website, https://reitsanalytics.ca. In my channel, I try to see the company from the long-term investment perspective. Is it a multi-bagger? So not only see just the intrinsic value, because the price is just a number. That number you can get from anywhere, right? So it's not a big deal. Number can change because the number drives. So I'll try to cover the main thing. Is the business is sound enough? So that's the key thing for me. If business is sound, then honestly speaking, even if the bad economy, it can go bad, but that cannot go bad, or some cases it can go even good. Second case is how strong the financial is, because it's telling us the story, right? So trying to see from the financial perspective, from what it's driving, right? So cash flow, and then do some patterns, revenue diversifications, and others. So depend upon the company, I will pick up so different, and also see the risk. What's the risk business has it, right? Because financial try to communicate that story to us, so in a different language, in accounting world language. So that's pretty much. So I'll try to get all the information, and then try to dilute it in terms of the charts, in terms of the very common layman language, so we can all speak and then get the feedback from the investor community and see if it's good for them as well, right? And I'll try to form my opinion if it's what it thinks from my portfolio perspective, and then I also request what you think from your portfolio perspective from that opinion of the stock, and try to be as transparent as possible and try to lay all the facts down. So that's pretty much on this channel. Who are new, okay, so let's get started. And if you're new, I request to give me a thumbs up. Okay, let me hide myself, and then so you can easily see the slides. Okay, so what is this REIT is, right? So this basically REIT is, as Tom also mentioned, and then it's not only Walmart, Tom. This is the Loblaws, Shopper Drug Market, Canadian Tire, and you can see these are the bigger brand names are there, right? So these are the industry leading. So the company is pretty well have a very good strong tenant based, right? So that's from that perspective, and we can see here as well. So they have a very leading industry occupancy rate, so which is very strong, right? If you have some property but it's not occupied, it's very cost effective, so we don't want to even touch that piece. But I have seen in their quarterly statements, because I just want to go more deeper into it. So I see it's pretty consistent, honestly. That's 91 point in 8.1 or 2, and I'll share in the subsequent slides. The revenue from the 25% the revenue from the Walmart. That's pretty good, right? So they have a very strong, and they are well diversified. So not only in terms of renting, but they are also in hotels and other business. And okay, so let's go next. Okay, help, COVID help. The company gave 1 million square foot of rent-free build space to help the COVID-19 support effort. This is way good, right? So usually this is way good if the company is coming out and helping. And I thought I'll just put a slide there as well. So the Trillium Health, which is we know in Mississauga, is a very big health network, and Hamilton Health Science is also, which includes 13 hospitals, right? Which include 13 hospitals under these categories, right? And medical facility have accepted their offer, right, to support the frontline workers. So any gesture we can do to support this who are working there, it's well, and I really appreciate that. So I'll give one for sure, one bonus point for that. And right, let's go next. Okay, so this is their financial, the top view. And one good thing I really like about it, this is the monthly dividend coming. So every month seems like think from that perspective, right? You give your money to the big landlords. Only the price right now is 20.39, but the overall right, but and you get their money, right, every month, depend upon the share, right? So the yield is 9%. But look at this, right? On the 20, the earning per share is 1.78 until this year, right? This is the latest one, and the dividend is good as well, right? Dividend is this is the monthly coming. So latest was 0.142. I'll also show you the yearly dividend history, and this the share right now. This share is below their book value. Let me put this way, right? So this is a discounted share. This is the book value. So from that value perspective, it's very good to have this. The beta is a little bit high over 1, but I don't mind because it's giving the very good yield, and especially in terms of $20. We have many big company in the name of the growth, and they are charging insane, right? So from the value investor perspective, I think this is very good. Okay, so let's continue. So here you see this is the pattern from last 5 years. Every year end December 15, and the latest is 19 here, and we can see the diluted the earning per share. So this is $1.86, right? And the dividend per share is 1.81, which is way good, right? So think this way, that you invested some $20 and you are already getting here to around $3.5 or close to $4 back, right? Which is, if I do the math honestly, which is 1.86 plus 1.81, and I think share price, this is closer coming. You're getting at least the dividend you are getting back, right? 50%. But overall the price appreciation, because the gain come from 2 factors, as we know, right? From the price appreciation plus from the dividend, right? So if I divide that by 20.3, which is the market share, I'm already getting 18% back. That's why half of the yield is coming from dividend and half of the yield is coming from the price. So from that is a monthly coming return back. Okay, now let's see how their revenue diversification, and then we'll also cover their risk, and especially we'll see if when the leases are expiring, right? So let me hide myself. So I think I'm cutting off some of the screen. Okay, so let's see. So as you can see, they are only in the Ontario base. So who are the Canadian citizens or who's been living in Canada, like, and I'm a proud Canadian citizen as well. So we can see Canada, at least in being living here and being the property owners as well, I've seen the property price is going crazy here, right? So and very expensive, and this is Ontario, right? Ontario is very is crazy prices, and having that investment in terms of the properties is good, right? So they have well diversified. So I like it that they are diversifying in different part of the provinces, and but for sure the major the part is Canada. And one more thing to highlight here is the revenue is very good diversified. So they have something in Quebec, Ontario for sure. The major revenue is coming, but all other revenue and the asset mix is quite good. So major one is in terms of the area and the revenue is the number one Ontario, which makes sense, and the next big one is Quebec, and then we have Vancouver, where we know the property and the price is quite expensive, and then but they have some presence in other provinces as well. Okay, so let's get started. And some under construction which is outside, which is Atlantic regions, right? But here if I see which is already there. Okay, let's get started. Okay, in terms of the dollar amount, this they have divided the market into three sector. One is the greater VACTUM. What is VACTUM? VACTUM is Vancouver, Edmonton, Calgary. These are the top Canadian cities, Ottawa and Toronto, which and if we include the primary and secondary, right, their occupancy level is, they again mention it's 99%, right now, and the revenue is coming from these two higher cities, which is very good. So net so if you can see the revenue diversification, which is good in all three sections. So mostly it's coming from the prime area, and then these cities, and then other prime area, and then secondary area, which is a little bit of the prime area. Occupancy rating is pretty good as well. It's not bad. Let's go next. Okay, now if I compare their financial, this is their first. So for REIT we use the FFO, and for this the financial, if we compare the first 3 months compared to the last year for first 3 months, we see the net income increase, which is a very good sign, right? And also I have checked their dividend so far, it haven't stopped. So they paid monthly dividend irrespective. Right now I'm doing this video in July 2020, and it's already end of July. So they haven't announced the dividend for July yet, which I'm surprised, but overall until the June they have paid the dividend. Okay, but we see the overall is increase. One thing to point out here, they put here the fair value of some of the investment property, they decrease it, right? So maybe but irrespective of that, the overall the income is increased, which is by 8.8%. Now I want to focus on the if I see from the income perspective, right, and the occupancy rate. So let's go from the income from 2018 first quarter to 1, 2, 3, 4, 5, 6, 7, 8 quarters history, which is fair more than enough to see what's recently happening with the company. So we can see probably the revenue is increasing, except the first quarter in 2019 and this year, and then again the last quarter of 2019, right? 19, the revenue decline as well. This decline, and then otherwise the cash flow from operation was declined significantly in the first quarter and all, but the occupancy rate was actually here. If you see, it's a little bit less in this quarter, but not very less. But occupancy rate overall is good, but the revenue has some declination as well, right? Which directly affect their share price. I notice it's dropped there. Okay, so and one good point I want to also mention here, that the company is heavily investing in the project as well, which is coming. So the risk perspective is okay. So now so far I think before I continue with the risk, I like to add there. Okay, the company has a very strong tenant base. The revenues overall is going up and down, but from the dividend perspective is no problem, but except I haven't seen the announcement of this month dividend, that it's what's happening to the July month dividend, but up to the June is good. The major tenant base is good. So let's recap all those points. Right now, the main thing is do the renewal rate is happening. If the renewal rate is not happening, then there might be a problem, right? Especially in case of the monthly dividend, how the company, if not getting the cash flow right, how they're going to pay those dividend, right? So let's say, so the retention rate actually, when I see it's heavily dropped, let me put myself away so you won't get distracted again. It's 20% variance, right? This piece. So if we see as compared to the last year, the quarter end it dropped 20%, right? Which basically coming from the renewal rental rates is 14, which is their main talent, and if I is pretty good, but that's not from the main talent, right? Which is excluding anchors, which is 18%. So that's 2% coming from here. Rental rate. So rental, they are not. So rental is still not a problem. I think even if they won't able to increase that much because of this time. But the main thing is still from the small business point of view, and which is the main thing, right? If tenants won't like to stay with them, then that's a big problem. So when I see their tenant category in terms of the gross rent to see further, right, how much their tenants are in these sectors, which categories. So they are coming from the apparel and restaurants, leisures, special fitness, and other financial services, which is quite a high as well, right? Like 8.9%, 7%, 6, 5. So basically, since they are broadly well diversified in other sectors, but some are, for example, the major sector, right? I'm not sure how the economic will flow, because people maybe don't want to go to the restaurant. If restaurant is closing, how they want to renew the lease, especially, and the government put a stop there, but the economy is not that open up, right? So that's a problem I can see here, right? Same problem with the leisure good and toys, right? And the fitness is not opening up. How the fitness will work in the future? So how will be the new normal will affect these kind of a service, which other essential service like pharmacy, grocery, I'm less worried about. Home improvement, I'm less worried about, which is the major part. But when I see these are not less, right? It's almost like 9, 8, almost like 8, almost 8%. So that way. Now, in terms of the lease expiry, when these lease expiries, for sure, their major tenant is Walmart. The lease is not expiring soon, and I'm also less worried on the Walmart side. Other anchor, other major tenant, I'm less worried. But look at that. The main problem is if these two, when I see their top 25 tenants, that's a big list, right? So mostly anchor, but these non-anchor tenants, right, these are in million in square foot. So these are less, almost 0.7 million square foot is empty right now, and then this is growing, right? This 25%. So this is, I'm little bit concerned. Maybe they won't have it, or they won't renew, then the company won't get the cash flow. So maybe the dividend, what it's coming, it's at the risk, right? So this is a little bit risk how this REITs will behave in the new normal. So that's, I really like to quickly point out. Okay. So now in terms of the forming opinion, so the company is good, right? Company is good. Why? Because its presence in major part of the cities and near the highways. I noticed doing active development. Up until now, there is no problem in terms of the occupancy rate is 98%, which is good, right? Financials are good, dividends are paying good. So if I see the past pattern to now is very good. $20 you are getting that very high in terms of the dividend yields, right? We already checked that, so no problem. But the problems, I think it's going forward. How will be the new normal will be look like, especially those key tenants I highlighted, right? Because from the past we only see, okay, what's happening, but how it will, the past won't replicate the future. Future has some disruption, right? Like coronavirus and other thing. They are doing some active development in terms of the transit and all. You can read from their presentations, but that's a little bit a risk from their side. That's if you are planning to take that risk, I think that you think, okay, the company uh, can be okay from that perspective, from COVID and the new normal perspective. Maybe some of the lower tenant won't appreciate, then it's fine. But I think the risk is how it's this year or next year, how this is behave. But overall, I think the company is pretty good. So for that reason, I'll put the hold for this perspective. But some uh, who for the investor who has a very low risk tolerance, right? But who has some medium, and then they think, okay, the company is doing the good yield, and they believe in the strong, good projects, and who knows the economy. The project they are involved. So from that perspective, you can take a little bit more risk. I think this is a very good opportunity from that perspective. So depend. Let me know how you think, and I thanks again Tom Alexander, to point out this REIT. And one more thing I'd like to mention here. So the REIT is on the real estate investment, right? So from the overall portfolio perspective, you need to think how much allocation you want to do from the real estate. If you already own a house and maybe have some investment in condos or some the property directly, how much you want to invest. Some people, they want to allocate on that sector. In Canada, we know this is a growing sector, real estate, and haven't seen any problems so far. But how the new normal will be, let's see. Okay, let me know your opinion, what you think as well on this. If you can take a little bit extra risk and plan to invest, basically this monthly 9 plus closer to 10% dividend yield, which is a very good sign. And if you want me to cover any other stock, please put in the comment, and definitely will do that. Thank you again, and thank you for your time to being with me. Sorry, the video is usually 20-25 minutes, but I think that's worth it. We cannot just have that good investment in a very short period of time. We need to see from all perspective and dimensions. Okay, thank you again, and see you soon in next video. Bye for now, and don't forget to smash the like button.